Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode. Steve, it's been quite a turbulent time in the Toronto area housing market, hasn't it? The latest report from the Building Industry and Land Development Association paints a pretty stark picture. July 2025 was the worst on record for new home sales, even worse than the 90s downturn.
Absolutely, Janine. The numbers are quite striking. Just 3,007 new homes were sold from January to July 2025, compared to 4,434 in the same period back in 1990. This is a significant drop and suggests some deep-rooted issues in the market.
It's heartbreaking to see such low numbers, especially when you consider the growing demand for housing in the area. The report highlighted that July alone saw a 48% decrease in sales compared to July 2024 and an 82% drop from the 10-year average. Those are alarming statistics.
And if we break it down by housing type, condos took a particularly hard hit. Only 150 units were sold in July, which is 51% less than last year, and a staggering 89% below the 10-year average. This isn't just a slowdown, it's a significant market contraction.
Right, and what's particularly worrying is the inventory level. It's now at 20 months, the highest we've seen to date. A healthy market typically has an inventory level between 9 to 12 months. This oversupply suggests that demand is not keeping up with the available properties.
Exactly, Janine. The benchmark price for new condos remained flat at over $1 million, while single-family home prices dropped by 6% over the past year to $1.48 million. This price stagnation, combined with high inventory, signals that potential homebuyers might be holding off, perhaps waiting for prices to drop further or for more favorable economic conditions.
It's a complex situation, Steve. On one hand, we have these high prices and low sales, and on the other, there's a clear need for more affordable housing options. Justin Sherwood from Build mentioned the need for government intervention to prevent a prolonged downturn like we saw in the 90s. It seems like a coordinated effort might be necessary to address these issues.
Indeed, Janine, the federal government has already proposed some measures, like the goods and services tax rebate for first-time homebuyers and reducing development charges in some municipalities. These steps could help, but it might take more comprehensive policies to truly stabilize the market. Let's shift our focus to the recent earnings report from the Royal Bank of Canada. They've reported record third-quarter earnings, which is impressive, but there's also a concerning trend in their mortgage portfolio, particularly in Toronto and Vancouver.
That's right, Steve. While RBC posted a record profit with a net income of $5.5 billion, they're seeing rising impairments in their mortgage book. The rate of mortgage delinquencies, particularly those over 90 days, has become a significant issue, especially in the Greater Toronto area.
Exactly, Janine. In the GTA alone, the delinquency rate has climbed from 27 basis points a year ago to 42 basis points in the third quarter. This is a substantial increase and indicates that more homeowners are struggling to meet their mortgage obligations.
And it's not just Toronto. Greater Vancouver is also experiencing a rise in delinquencies, moving from 20 to 27 basis points over the past year. This suggests a broader pattern of financial stress among homeowners in major Canadian markets.
The bank's provisions for credit losses also reflect this stress, increasing to $881 million this quarter compared to $659 million a year earlier. It's clear that while RBC is performing well overall, there's a growing concern about the health of their mortgage portfolio.
Despite these challenges, most borrowers still have significant equity in their homes. RBC's uninsured mortgages originated this quarter have an average loan-to-value ratio of 70%, and the overall portfolio is at 58%. This equity can provide a cushion for homeowners who might be facing difficulties.
That's a good point, Janine. The majority of RBC's mortgage book is uninsured, which means that borrowers have more skin in the game, so to speak. This might help mitigate some of the risks associated with rising delinquencies.
Absolutely, Steve. It's also worth noting that RBC's forecast assumes housing prices will rise modestly over the next year. If this holds true, it could alleviate some of the pressure on homeowners and potentially stabilize delinquency rates.
We'll definitely need to keep an eye on these developments. While RBC's earnings are strong, the rising delinquencies in Toronto and Vancouver are a reminder of the underlying vulnerabilities in the market. The Bank of Canada is preparing for its 2026 Monetary Policy Framework Review, and Governor Tiff Macklem has indicated that housing affordability will be a key focus. This is an important development given the impact that monetary policy has on housing demand and affordability, especially in markets like Toronto and Vancouver.
That's right, Steve. In a recent speech in Mexico City, Governor Macklem highlighted that while monetary policy cannot directly increase the supply of housing, it does have a significant effect on housing demand through interest rates. This is crucial because housing is a major component of the Consumer Price Index in Canada, and therefore it affects inflation.
Exactly, Janine. Macklem mentioned that the Bank of Canada will explore how monetary policy affects housing sector dynamics and how best to integrate housing affordability into their focus on overall price stability. It's an acknowledgement of the challenges many Canadians face in the current housing market.
Governor Macklem also hinted that the bank might revisit how it measures underlying price pressures. This comes as policymakers deal with more frequent supply shocks that can distort traditional inflation readings. It's a move to ensure that the bank's policies remain effective in a changing economic landscape.
And while these adjustments are being considered, it's clear that the bank will maintain its 2% inflation target. This has been a consistent goal since 1995, and despite exploring alternatives like price level targeting, the bank has repeatedly concluded that 2% is the right target for Canada.
It's interesting to see how the Bank of Canada is trying to balance its traditional goals with the current economic realities. Housing affordability is a complex issue that involves multiple factors, and while monetary policy is a tool, it requires a coordinated effort with government policies to truly address the challenges.
Absolutely, Janine. As the Bank of Canada and the federal government work together on this review, it's crucial that they consider how these policies impact Canadians across the board. It's about ensuring that the frameworks in place support not just economic stability, but also the well-being of individuals and families striving for homeownership.
Steve, I came across an interesting discussion with Richard Ramirez, the CEO and co-founder of Zone, about the impact of seniors holding onto their homes longer than before. It's fascinating how this trend is affecting the overall real estate market in Canada.
Yes, Janine, I read that as well. Ramirez pointed out that many seniors prefer to stay in their detached homes rather than downsizing, which is contributing to the supply shortage in the market. This lack of turnover is creating challenges for first-time homebuyers who are often looking for these older, more affordable homes.
It's understandable why seniors might choose to stay put. They want to maintain a certain lifestyle, having a backyard for family gatherings, for instance. But the lack of suitable alternatives, like single-level homes with easy accessibility, is a big barrier for them to move.
Exactly. Ramirez mentioned that only about 5% of seniors are selling their homes, compared to 13% of the general population. That's a significant difference, and it's putting pressure on the market, especially for younger Canadians who are now facing a double squeeze.
Right, and that double squeeze is quite concerning. Young Canadians are paying nearly 50% of their net income on rent, making it incredibly difficult to save for a down payment. The lack of available homes to buy only exacerbates this issue, as Ramirez noted.
And with the average age of first-time homebuyers now over 35, it's clear that this is a growing problem. Ramiz emphasized the need for policymakers to find alternative solutions to help young Canadians achieve homeownership. It's crucial for maintaining the Canadian dream of owning a home.
Absolutely, Steve. Homes are more than just investments. They're places where families build memories. It's vital that we find ways to make homeownership more accessible so these younger generations can also have the opportunity to create those lifelong memories. Steve, let's talk about something that's really important to both mortgage brokers and borrowers: renewal rates. There's a common belief that banks will always match the lowest rate out there when it comes to renewing a mortgage, but recent insights suggest that's not always the case.
That's right, Janine. Vincent Tong, the principal and co-founder at DLC Clear Trust Signature Mortgages, highlighted that while banks are indeed competing fiercely for renewal business, they're not always going to match the best rate available. It seems that there are cases where banks simply say, take it or leave it.
Exactly, Steve. And that's where the role of a mortgage broker becomes so crucial. When a bank refuses to match a lower rate, it emphasizes the value brokers offer by showing clients that they've explored all options. It's about guiding the client through the complexities and finding the best possible solution for their situation.
Absolutely, Janine. Tong mentioned that sometimes banks have internal guidelines or pricing strategies that prevent them from matching another lender's rate. These could be based on their treasury pricing, liquidity premiums, or even internal client scoring algorithms. It's not always a straightforward decision for them to match rates.
And for borrowers, it's not just about finding the lowest rate, but also about managing their financial situation. With rates having increased significantly since the pandemic, some are struggling with their current payments. They're looking at options like refinancing or re-amortizing to lower their monthly liabilities.
That's a great point, Janine. The renewal wave that we're seeing now is significant, but according to TD economist Maria Solovieva, there doesn't seem to be an imminent crisis. Thanks to recent interest rate cuts, many homeowners have options to manage their payments, whether by extending the amortization or refinancing.
It's reassuring to know that despite the challenges, there are measures in place that can help homeowners navigate these tough times. But it's also a reminder of how important it is for borrowers to be proactive and informed about their options, rather than assuming banks will automatically offer the best deal.
Exactly, Janine. It's all about understanding the landscape and having the right guidance to make well-informed decisions. As we continue to see changes in the market, staying informed and exploring all options remains key for both brokers and borrowers alike.
Steve, there's been quite a stir in the Ontario real estate community recently with the collapse of iPro Realty Ltd. The Real Estate Council of Ontario has taken some significant steps, including freezing bank accounts related to iPro and initiating an outside review of its own conduct.
That's right, Janine. This situation has caught a lot of attention, especially given iPro's size and influence in the market. They were one of the largest brokerages in the province, with over 2,400 realtors and brokers. It's a serious matter when more than $10 million goes missing from trust fund accounts.
It's certainly concerning, Steve. The community is demanding answers, and the pressure is mounting on the regulator, RECO, to explain how this happened and what will be done to prevent it in the future. Steve Tabrizi from Re/Max Hallmark Group of Companies pointed out how vocal the community has become on social media, questioning RECO's handling of the situation.
Indeed, Janine. There are questions about who knew what and when. The former registrar, Joseph Richer, had an agreement with iPro's owners to wind down the brokerage, but it seems there were assurances that RECO wouldn't pursue further disciplinary investigations. This has raised eyebrows, especially considering the financial implications for realtors and consumers involved.
Yes, and the fact that RECO's CEO, Brenda Buchanan, announced that Mr. Richer is no longer in his position adds another layer to this complex issue. The lack of clarity on whether he resigned or was let go only fuels speculation. It's good to see that RECO has retained Dentons Canada LLP to conduct an independent audit, though.
Right, Janine. This audit is crucial for restoring trust in the regulatory system. Dentons will not only review the iPro matter, but also provide advice on ensuring better oversight and governance moving forward. With the significant transactions that occurred before the public was informed, it's vital that these issues are addressed transparently.
Absolutely, Steve. The involvement of such a large law firm indicates the seriousness of the situation. And with RECO's commitment to reviewing all open compliance files, it seems they're taking steps to prevent rogue players from undermining the sector's integrity in the future.
It's a challenging time for the industry, Janine, and it's important for the public to see that accountability measures are being put in place. As Gloria Valvasori from Century 21 Signature Service noted, the failure to hold those responsible accountable erodes public confidence in the entire real estate industry. This is an opportunity for RECO to demonstrate its commitment to effective regulation.
Well put, Steve. It's about rebuilding trust and ensuring that the sector is regulated effectively to protect both realtors and consumers. As we follow this story, it's essential to keep an eye on how these measures unfold and the impact they have on the market.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time, and stay informed with the latest industry insights.